venture capital is just for tech billionaires or Silicon Valley insiders? Not so fast, because today we're diving into why that might not be the case at all. What I'm about to share could completely change how you view venture capital and why it might be more accessible than you think. And stick around till the end because I've got a bonus tip on how to get started in VC investing without needing millions of dollars. I'm Rich Smith, and I help business owners and high net worth individuals understand the world of venture capital better so you can make smart investment decisions. If you've been hesitant to get into venture capital because it feels out of reach, you're definitely not alone. Today, we're breaking down what venture capital is, how it works, and how you can take your first steps into this exciting investment world. A lot of business owners assume venture capital is out of reach, but when you understand how it works, you'll see there's room for you to get in on the action. So what exactly is venture capital? You've probably heard about it being a big part of the startup world, but how does it really work? Let's break it down. Venture capitalists, or VCs, provide funding to startups and early stage companies in exchange for ownership stakes or equity. But here's where it gets interesting. Unlike a bank loan, VCs aren't expecting monthly payments. Instead, they're betting that the startup will grow and they'll cash out when the company is sold, goes public, or has an exit. Now, I'm not gonna sugarcoat it. This is a high-risk game. Many startups fail, but the few that succeed can bring in massive rewards. And that's what makes venture capital so appealing to many people. You see, VC firms raise money from high net worth individuals, institutions, and other companies. They pool this money together and invest it in a variety of startups, hoping to strike gold with at least one or two unicorns. Think about it. Even though most startups won't become the next Google or Uber, VCs are counting on that one big win or two in order to more than cover the losses from all the other businesses. And while tech tends to dominate the venture capital world, it's not the only industry. In fact, healthcare and clean energy are just a couple of sectors that are growing fast, and VCs are taking notice. I'm sure you've heard of Silicon Valley, and that might be the venture capital hub of the world, but you might be surprised how many other cities around the globe are building vibrant startup ecosystems. So let's dive into exactly how a VC firm decides which startups to invest in. Spoiler alert, they're not just throwing money around. It all starts with the pitch. Founders present their big idea, their business model, and how they plan to grow the company. It's an awesome but high stakes moment because first impressions matter a lot here. But it's not just the idea that gets the VCs excited. They're looking at several key factors before they make their decision to invest or pass. First up, the founder and the team. A great idea is one thing, but without the right people behind it, it's not going anywhere. VCs want to see a strong, motivated founder with some sort of experienced team, even if it's small, that can help them turn that vision into a reality. Next, it's also all about the market. VCs want to know there's a big market for the product, service, or at least the idea. And the bigger the market, the bigger the potential for returns. If the startup is tackling a unique problem or working in a fast-growing industry, then that's a huge plus too. Then comes the business model. It's one thing to have a cool product, but how is it going to make money? And more importantly, will it keep growing that revenue over time? VCs love scalable business models, ones where the revenue can grow without massive extra costs and overhead. And finally, the exit strategy. VCs need to know how they're going to make their money back eventually. They're looking for startups with some sort of clear path, even if they don't have it at the beginning, to either be acquired, go public, or total marketplace domination. Without a potential exit in sight anywhere, the investment just may not be worth the risk. And still, even with all the boxes checked, it's a high-risk game. But that's the thrill of venture capital. Now, let's see what happens after a VC firm makes its investment. There are stages of venture capital funding, so let's start with the early days. You're going to hear a term like pre-seed and seed funding. At this stage, the startup might just be an idea or or let's say a rough prototype. The money is going to help the founders build that product or run the market tests or simply hire a small team like I mentioned before. This stage can be super high risk, but the rewards can be huge if the startup succeeds. Let's move on to the Series A stage. By this point, the startup has a working product and it's showing early signs of success. The focus shifts to scaling the business, growing the customer base, increasing revenue, and of course, continuing to build out a solid team. Series B round and beyond are for startups that are ready to take it to the next level. They're expanding into new markets, hiring even more employees, and sometimes acquiring other companies. At this stage, the business model is proven and the company might even be gearing up for some sort of an exit. But remember, not every startup goes through all these stages. Some might just completely fail. Some might get acquired after a few rounds, a Series A round, for example. And others might go, like I mentioned before, through multiple bridge rounds of funding before they are ever even close to being ready for anything that resembles an exit. Now, if you're like me at this point, you might be wondering, how does a venture capital fund actually work? Well, if you're interested in investing in one particular fund, there's always two main players, the general partners and the limited partners. The GPs are the venture capitalists themselves. They manage the fund, source the deals, and work closely with the startups. They're also responsible for raising the fund's capital and growing the startups they invest in. Of course, in return for their efforts, the GPs or general partners earn a management fee, which is typically around 2%, and share in the profits known as carried interest. The LPs or limited partners, on the other hand, are the investors in the fund, but they take a hands-off approach. So what's their goal? Earning a return on their investment. And pretty much they aren't involved in the day-to-day management of the fund. This structure, the one I just described, allows VC firms to pool resources, invest in startups, and manage risks, all while aligning with the interests of both the GPs and the LPs. So, where does the rubber meet the road, so to speak? Simply put, venture capital is high risk, but the rewards can be enormous. Still, VCs don't see returns overnight. It often takes years before they exit and can see a profit. Now, one of the most celebrated exits is through an IPO, and that's when a private company goes public and sells shares to the general public. And if that company performs well, then those early investors can make huge returns. Another common exit strategy is an acquisition, and that's where a larger company buys the startup. And this allows the VCs to sell their shares for a profit. Acquisitions can be extremely lucrative, especially when big companies are looking for innovative technology or business models. These exit strategies that I'm talking about are crucial because they allow VCs to return money to their limited partners. And that fuels the cycle of investment, growth. In my opinion, the cornerstone of the startup ecosystem is venture capital because it provides both the funding and the expertise to help businesses grow. I'm Rich Smith, and I help business owners and high net worth individuals understand the world of venture capital. You should check out the link in the description of this video for a bonus tip on how to get your foot in the door of the VC investing world. And I want to hear from you. What burning venture capital questions do you still have? Drop them in the comments below and let me know what you want to see next on this channel.